Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Quick Guide to Break-Even Analysis. Simplify your finances. Formula for break-even analysis. The formula for break-even analysis is simple but essential. Here's what you need. Break-even point, in units, equals fixed costs divided by sales price per unit variable cost per unit. In this formula, fixed costs are your constant expenses, like rent and salaries. Sales price per unit is how much you charge for each product or service. Variable cost per unit represents the costs that change with each sale, like materials or labor. Sales price per unit variable cost per unit is the contribution margin. It's the amount from each sale that goes toward covering fixed costs and eventually generating profit. This formula calculates the number of units you need to sell to break even. If you want to find your BEP in dollars instead, multiply the result by the sales price per unit. Break-even point, in dollars, equals break-even point in units times sales price per unit. It's a straightforward calculation, but it gives you invaluable insight into your business's financial foundation. Example calculation. Let's break this down with a real example. Imagine you run a boutique that sells handcrafted candles. You want to figure out how many candles you need to sell to break even. Here's what you know. Fixed costs, $5,000 per month, rent, insurance, salaries. Sales price per unit, $25 per candle. Variable cost per unit, $15 per candle, materials, packaging. Step 1. Calculate the contribution margin. Subtract the variable cost per unit from the sales price per unit, $25, sales price, $15, variable cost, equals $10 contribution margin. Step 2. Plug numbers into the BEP formula. Divide your fixed costs by the contribution margin. $5,000 divided by $10 equals 500 units. You need to sell 500 candles in a month to break even. Step 3. Optional. Find the BEP in dollars. Multiply the units by the sales price per unit. 500 times $25 equals $12,500. This means your boutique needs $12,500 in revenue each month to cover all costs. Is 500 candles a realistic goal for your business? This calculation helps you evaluate that. It also highlights areas for adjustment. Reducing fixed costs, increasing your price, or lowering variable costs can all make breaking even easier. By laying everything out in numbers, you turn guesswork into a clear action plan. That's the power of break-even analysis. Types of break-even analysis. Break-even analysis isn't one size fits all. Depending on your business goals or product range, you may need to take different approaches. Below are 2 common types of break-even analysis that can give you deeper insights: multi-product break-even analysis and target profit analysis. Both provide clarity but focus on distinct areas of profitability. Multi-product break-even analysis. What happens when your business sells more than one product? Calculating the break-even point gets more complex because each product has its own costs, prices, and contribution margins. Multi-product break-even analysis helps you account for these differences by factoring in each product's role in your overall sales mix. Here's how it works. Determine the sales mix. Identify the proportion of each product in total sales. For example, if you sell 2 items, product A, 60% of sales, and product B, 40% of sales, this ratio guides your calculation. Calculate the weighted average contribution margin, WACM. Find each product's contribution margin. Subtract its variable cost per unit from its sales price per unit. Multiply each product's contribution margin by its share in the sales mix. Add these totals to get the weighted average contribution margin. Apply the break-even formula using WACM. Use your fixed costs and divide them by the WACM. This gives you the total units you need to sell across all products to break even. From there, you can use the sales mix ratio to estimate individual product sales. For example, suppose your fixed costs are $10,000 and the WACM is $15. To break even, you'd need to sell 667 total units, $10,000 divided by $15. If product A makes up 60% of sales, your target is 400 units of product A and 267 units of product B. Multi-product break-even analysis ensures you're calculating profitability accurately, even when juggling multiple revenue streams. Target profit analysis. Break-even is just the starting line. If you want to achieve a specific level of profit, target profit analysis takes your calculations a step further. Think of it as adding a financial goalpost beyond breaking even. Here's how you can calculate your sales to hit a profit target. Modify the formula. Use the classic BEP formula but add your target profit to fixed costs. Required sales in units equals fixed costs plus target profit divided by contribution margin. Adjust for dollars. If you want the sales in dollars rather than units, multiply the result by the sales price per unit. Let's break this down with an example. Imagine your fixed costs are $20,000, and you aim to earn $5,000 in profit. Your product has a $10 contribution margin. Here's what the math looks like. Step 1. Add fixed costs and target profit. $20,000 plus $5,000 equals $25,000. Step 2. Divide by the contribution margin. $25,000 divided by $10 equals 2,500 units. Step 3. Optional. Convert to dollars. 2,500 units times $30 sales price equals $75,000. This means you need $75,000 in sales, or 2,500 units, to achieve your $5,000 profit goal. Target profit analysis allows you to plan beyond survival, giving you a roadmap to reach long-term financial goals. It also offers insight into whether those goals are realistic based on your current cost structure and pricing. Limitations of break-even analysis. Break-even analysis, B, is an essential tool for business planning, but it's not without flaws. While it offers a clear snapshot of where costs and revenue intersect, its simplicity creates blind spots. These limitations can lead to misguided decisions if not fully understood. Static nature of break-even analysis. Break-even analysis assumes that costs, prices, and sales volumes remain constant over time. But in real life, markets are dynamic, not static. Prices fluctuate, customer demand changes, and external factors, like economic shifts or competitor actions, can create waves. B doesn't adapt well to these ongoing changes. For example, imagine you've calculated your BEP based on current pricing and variable costs. A sudden spike in material prices or a competitor slashing their prices could throw those calculations off balance. B isn't designed to factor in these ongoing shifts, potentially leaving you working with outdated or inaccurate data. A more realistic approach might involve updating your numbers regularly. Even then, no static formula can predict how a competitor's new product launch or a global supply chain disruption might impact your bottom line. B works best as a snapshot, not a long-term blueprint. Oversimplification of costs and revenue. Break-even analysis classifies costs as either fixed or variable and assumes all products sell for the same price. Real-world scenarios are often more complicated than that. Oversimplifying these elements can lead to significant inaccuracies. For starters, some costs are semi-variable. They don't fit neatly into either category. For instance, utility bills may rise as production increases, but they're not fully variable. B doesn't account for these nuances, potentially skewing your calculations. Revenue assumptions can also cause trouble. Most businesses sell products or services at various price points. Discounts, sales, and tiered pricing structures all affect actual revenue, and B doesn't handle this complexity. Instead, it assumes a single price per unit, creating a gap between theoretical and actual performance. This oversimplification can be compared to estimating the cost of a road trip by only considering gas prices while ignoring tolls, hotel stays, and food expenses. You'll get a ballpark figure, but the final cost may be far from your expectations. The same applies to B. It works as a basic guide, not a precise forecast. By understanding these limitations, you'll be better prepared to use break-even analysis as one piece of a larger decision-making process. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.